All right, let's dive into CTS Global's 2025 performance. Now, if you're a shareholder or even thinking about investing, our goal today is to look right past those big headline numbers and really uncover the story that the financial data is telling us. And yeah, the headline that's got everyone talking is this one, a 93% drop in net margin. I mean, that's a number that would make anyone's jaw drop. It looks like a huge red flag, right? So the big question is, what on earth happened? To figure that out, we've got to dig into the key performance indicators. And when you put 2024 and 2025 side by side, the difference is just stark. You can see their revenue over capital, which is a great way to measure how efficiently they're using their money, took a pretty big dip. But the real shocker is that net margin. It plummeted from almost 40% all the way down to 2.6%. You see numbers like that, and you've got to ask some tough questions. So, to figure out how we got to this point, we first have to understand the world CTS was actually operating in. You see, the story really starts with them trying to navigate some serious market headwinds in 2025, a year that was basically defined by this new and pretty challenging post-rate hike equilibrium. You know, the big economic picture in 2025 was really a tale of two different worlds. On one side, you had these global tailwinds, with markets like the US doing great. But on the other side, right at home in the Philippines, the company was facing some major domestic headwinds. The momentum was cooling off. This just created a super complex environment that called for a really tactical, very defensive strategy. And this chart just captures that split reality perfectly. Look at this. The US market, the S&P 500, gave a really strong 17.9% return. Awesome. But at the same time, the local Philippine Stock Exchange Index actually went down by over 7%. So just imagine, CTS was basically forced to sail in two completely different currents at the exact same time. Okay, so how did that tough environment actually hit the company's bottom line? Well, that brings us to the revenue drop. We're talking about their top-line numbers falling from 162.5 million pesos down to 108.4 million. Now, this revenue breakdown is super helpful because it pinpoints exactly where that drop came from. You can see here, starting from that 2024 base, the two biggest things pulling it down were global and local trading. I mean, other things moved around a little bit, sure, but the story of 2025 revenue was almost entirely about lower trading gains. Now, before we go any further, we have to get our heads around a really key idea: unrealized losses. Just think of it like this. If you own a stock and its price goes down, but you don't sell it, have you actually lost money? Not really. It's what they call a paper loss. You still own the asset. And this little distinction is absolutely critical for understanding what happened next. And here we go. This is the heart of the matter. The company actually made a very healthy 36.3 million pesos in realized gains. That's profit from assets they actually sold. But look at this. That profit was almost completely wiped out on the books by 34.3 million in those unrealized or paper losses from strategic assets they decided to hold on to. So, here it is. This is the single most important thing to take away from all this. That massive drop in profit, it wasn't because of bad trades or poor performance. No, it was a calculated, strategic choice to hold on to valuable assets for the long run, even if it meant taking a short-term hit on the accounting sheet from those paper losses. And you know, that strategic decision, choosing long-term value over a short-term profit, brings us to what I think is the most important part of the entire 2025 story. We need to look right past that income statement for a second and focus on the balance sheet, because that's where you find the real foundation of the company's strength. I want you to think of their balance sheet like a financial fortress. Yeah, profitability took a hit, but it was a planned, strategic hit. And meanwhile, the company's actual underlying financial health, its ability to pay its bills, its liquidity, it all remained incredibly strong. It's really built on three key pillars of stability. Pillar number 1, a risk-based capital adequacy ratio of 640%. Okay, that sounds really technical, but all it means is that the company has a massive financial cushion. It's way, way more than regulators require, and it shows they can absorb pretty much any market shock you can throw at them without even breaking a sweat. Pillar number 2, the current ratio is over 5. What does that mean? Well, for every single peso in bills they have to pay in the short term, they have more than 5 pesos in cash or other easily accessible assets just sitting there ready to cover it. It's a crystal clear sign of rock-solid financial health. And the third pillar of this fortress? A debt-to-equity ratio of just 0.11. I mean, wow, the company basically operates with almost no debt. This makes them unbelievably resilient and keeps them safe from all that credit market chaos that can just cripple other companies that are loaded up with debt. So, with a balance sheet that strong, how does that shape their game plan for the year ahead? Well, all of this wasn't just about playing defense. It was about preserving their capital to give them the maximum number of strategic options as they head into 2026. You see, that powerful capital base is now the launching pad for some really aggressive growth plans. The strategy is now all about expanding into new markets across Southeast Asia, launching new advisory services that can scale up, and even leveraging their expertise into totally new types of assets. And honestly, the company's own report just sums it up perfectly right here. It totally acknowledges that the tough environment squeezed their margins, but it correctly points out that their fortress balance sheet is the key. It's what lets them call their own shots and dictate their own future, no matter what the market is doing. So this leaves us with a final, and I think really crucial question. When you see the whole picture, was 2025 really a year of weakness for them? Or was it a masterclass in strategic patience? In a world this volatile, maybe, just maybe, the smartest path to aggressive growth is to first spend a year building a foundation that is absolutely unshakable.